Madanagopal Ramu from Sundaram Mutual Fund to talk more about earnings and the market factors. Mr. Ramu, thank you very much for joining us. First of all, I'd like to understand from you, this is the time of so many investor conferences which are happening right now. Chetan Aya was just on my show an hour back and was telling me that there are rate cuts which are likely to start across the world in the next 6 to 8 months. By year end, he expects Indonesia to be the first one. And in total, US could see 4 rate cuts of 25 bips each in entire 24. And India may see 2 rate cuts. I want to understand from you, has markets already started factoring in rate cuts in terms of valuations or not yet? Till they come very close by or actually start happening, market will not factor that in.
Yeah, hi, thanks. I think market is yet to factor in a possibility of a rate cut very clearly. The fact that market seems to have consolidated almost for 18 months, and then the earnings growth in India has been pretty strong. Even in Q4, we have seen, excluding commodities, very strong earnings growth in the for the domestic stories. So we expect the markets to see a reasonable rebound if the rate cuts become much more clearer. We are discussing about a rate cut which can potentially happen somewhere down the line. It could be 6 months down the line or 1 year down the line, but essentially the rate cuts are likely to happen. And given the commodity prices have come down and inflations are coming down, inflation numbers are coming. So we still feel markets are yet to factor in this rate cut scenario. We can see a reasonable rebound in the overall sentiment in the Indian indices if the rate cuts become much more clearer.
Right. Right. Mr. Ramu, I want to understand with you, how are the interest rate sensitive sectors, though we are seeing sparks of activity already happening, but if I were to ask you that, the real estate index, the auto index, or even bank nifty for that matter, in this entire rate cut cycle in India, how are the interest rate sensitive sectors likely to behave? Or if you could share how they have behaved in the past rate cutting cycles.
Obviously, a rate cut sort of a scenario is very positive for growth cyclicals, and banking, auto, consumer discretionary, all these companies fall under growth cyclicals. If you observe for the last 12 to 18 months, despite strong earnings growth in all these three sectors, we have not seen any massive earnings or massive sort of a stock price re-rating. So we expect that once the inflation is already heading down, right? So if the rate cut also starts coming through, you will see investors becoming much more positive to growth cyclicals, and that will always be positive for sectors that you mentioned. And we, as a house, also we are very positive on that space. And the Sundaram alternates, we have invested heavily into the growth cyclicals, and our outlook is very positive for the segments that you mentioned. In the past, also, whenever inflation has spiked, we have seen these sectors consolidating for a short period. But once the inflation is behind you, they have come back and delivered good returns to the investors. The broader premise is that India growth story still looks very encouraging, and given that growth is continuing, and now the inflation is also coming down, and interest rates are also heading downside, which that scenario is always positive for the growth cycles.
Right. Okay, let's talk about earnings. There is also a view this time round, earnings quality came in line to slightly better than what the street was estimating. Ahead of the earnings season, fear was that earnings may come under pressure in a very sharp manner. That did not really happen. Over the next 12 months, what are your thoughts on how resilient the earnings could be for corporate India?
On the broad framework, if you look at, if you exclude the commodities impact, the earnings growth has been strong even for the last, say, 2 quarters also, where we would have expected some bit of moderation given the high inflation scenario that was going on, right, for the last, say, 2 quarters. But we have crossed those high inflation period without much impact on the earnings front. A lot of surprise came in the earnings side from the margin front, and also supported by some sectors where the top line growth was also encouraging. Broadly, if you look at, there was a lot of negativity around consumer discretionary, auto, and all. But I think there was a lot of more resilience in few segments of these sectors also, and therefore overall the disappointment was not very high. And banking supported earnings purely with the help of credit growth recovery, which rebounded post COVID, as well as the provisioning numbers were much lower than the previous cycles, given the support that they got from the say recovery post COVID. Therefore, the earnings growth has been supported by a few of these sectors like banking, financials, and the NBFCs particularly had a reasonable beat compared to expectations because the cost of borrowing was not so high as it was expected. So the banking per se was doing very well, and then supported by some of the consumer sectors. Even FMCG sector, which has not seen a massive volume growth, but still managed to deliver from the margin perspective. So broadly, I would say sectors like banking and some of the consumer-facing sectors, urban consumer-facing sectors, delivered on volume front. But if you look at many sectors delivered on the margin front. Overall, put together, that kind of led to a mid-teen sort of PAT growth, excluding the commodities. If we include commodities, yes, the numbers look much muted. The broader number looks like a 5% sort of a PAT growth, but you have to exclude commodities to see the real earnings growth, in our opinion.
Right. All right, Mr. Ramu, we'll let you go on that one. Thanks so much for joining us today and chatting about markets and investing. Look forward to having you again on the show. Let's take a short break on that note. But before we go, we'll tell you about